Well, hello, everybody. Great pleasure to be with you all this morning and to kind of share our thoughts about meaningful collaboration. I think that's the takeaway here. I'm pleased to be joined on stage by Wouter from Rabobank. I'm Flav from PrimeRevenue. I have since changed my hairstyle since that picture was taken. But needless to say, we're excited to talk a little bit broadly about what's happening in the trade finance space. And we kind of want to focus the conversation today, be a little bit more collaborative, but focus the conversation on four different parts. We're going to touch kind of what's happening macro in the supply chain finance field. What is our financial institution partners? What are they seeing? What are the fintech partners seeing? Then kind of get into some of the innovations and market drivers, market dynamics that are happening. Then kind of talk about collaboration in a general sense. How are we seeing fintechs and financial institutions collaborate and work together for good outcomes for the customer? But then maybe talk a little bit even more specifically about our partnership with Rabobank and PrimeRevenue and how we've been able to derive some creative solutions to be able to serve the customer better. And then we'll kind of look ahead and try to make some statements of where we think the industry is going in general with supply chain finance. And then hopefully we'll have some opportunity to let you all weigh in and, pepper us with some questions and try to weigh in our opinion of how we think the sentiment is going. But overall, meaningful collaboration, ultimately, we want to be able to deliver the best outcome for the customer. And so maybe I'll kick it off to Wouter and I'll say, how are macroeconomic conditions and some of the technology trends that you're seeing shaping the working capital strategies of today?
Thanks, Flav. Nice seeing all of you here. Macroeconomic, of course, we're seeing tariffs have quite an impact. There's some geopolitical instabilities as well. We've all seen what's happening in India, Pakistan, and what has been happening all across the globe before as well. So resilience and robustness of the supply chains is really key. And we think our working capital solutions that we offer as a bank or as a fintech or jointly can really help with that. To give some concrete examples, for example, in the renewable energy supply chain, we see some of our clients being asked to set up massive renewable energy projects dedicated for data centers, for example, for Google or others. Those are like more than 2 gigawatt projects, massive, but there's a large dependency on China. So I'm not sure if it was part of Trump's master plan. I don't think it was. But the tariffs have really exposed how we are dependent on other countries for our imports. And it's not just that, it's also China basically putting a ban on the exports of rare earth materials. You see all of that, not helping in terms of resilience. What we see our clients do, what we think our clients will be doing is in the medium or the longer term, they will localize supply chains. So I think Tesla is a very good example in the US. They have their own battery facilities in Nevada already for a long time. They have their own lithium refinery in Lathrop. So they're sort of ahead of the curve of what we think other clients will be doing, localizing supply chains, being less dependent. But in the shorter term, we think banks and fintechs can really help out in making those supply chains more resilient by offering working capital solutions.
Yeah. So fully understand and agree with kind of the sentiments that you're seeing. A lot of dynamics, a lot of changes, and we're seeing it from the supply chain finance, the fintech point of view as well. And the driver, we feel like more is being expected. The bar is constantly being raised of what the customer is expecting due to all these shifts and changes in the landscape with tariffs, with the shifting supply chains, and whether it's nearshoring or all the other topics that are happening. More is being expected from the fintech. Our customer wants data-driven approaches. They want real-time analytics. They want to be able to see where their invoices are. They want to get as deep of visibility into the supply chain as they can. So the bar is constantly being raised. And how do we do that as a fintech provider with transparency to make everybody be able to create better value and see kind of the trends and the shifts in real time? So that's kind of the challenge. That's kind of what's driving some of the market dynamics at the time. And we're looking to automate and to change in that direction, to make sure that we're staying robust and resilient, to offer those improvements, end-to-end payment solutions, and be able to show that visibility with data-driven results. And that's kind of critical in this time period, at least from the fintech's point of view. And so that kind of leads us into this theme of, innovation and kind of what's driving the evolution of SCF, and how are some of the fintechs and financial institutions adopting it and kind of in that direction. So I'll kind of start, and then Wouter can add from the Rabo point of view. But we're seeing as a fintech, some of the trends in the marketplace, right? We're seeing embedded finance starting to become a real theme that is taking hold. Companies are looking for the ability to automate their payment executions as much as possible. Their companies are looking to be able to assess their risk in real time, as I was mentioning, to be able to dynamically allocate liquidity and kind of know where their invoices are throughout the life cycle from approval to maturities or payment. And we've heard it here on stage, right? Like every panel that we've had over the last couple of days has at least mentioned AI. There's a big driver there that's starting to shape some of the innovations, and like it or not, right? It's impacting our field in the trade finance space. So I think that being able to utilize that as a tool to be able to offer those transparencies, those better data analytics, those better insights are going to be a key driver of some of the innovation. So we want to be able to use that for risk analysis. We want to be able to use that to optimize funding allocations, risk mitigations. And so fintechs like PrimeRevenue are hoping to use this trend to accelerate the evolution of API-driven integrations with our partners, and be able to just have modular platforms that are able to scale and grow to be able to offer that sort of transparency and inclusion that drives the value in the supply chain finance space. What are you guys seeing? What are some of the innovation drivers?
Yeah, I think I definitely agree with you, Flav, on the AI front. I think fintechs might be a step ahead there of banks. As banks, we always try to be very cautious, and everything that we use new. For example, AI goes through at least a couple committees, and those committees tend to take a bit of time. So it's really helpful if you're rolling out a supplier finance program. You want to make it as impactful as possible to use all the data you have available and apply AI to that, to make the rollout of a program as effective as possible. I think other trends we're seeing is deep tier supplier finance. So obviously, I think most of you in the audience will be familiar with standard supplier finance. Let's say the strongest credit has a 1% cost of financing. The weaker credit, the supplier, is 3%. You can basically add 2% of value by stepping in as a bank and leveraging the stronger credit to finance the weaker credit. So everyone knows that. Deep tier financing, you're going one step further down the chain. You're going to that supplier of the supplier, and they may be paying 6-7%. So you're unlocking a lot more value, but it also becomes more complex from a technical perspective. We do have a couple of live transactions, but I do have to say this is relatively in its infancy. And as things get automated, as we can apply more AI, as we can sort of tokenize things, I do see, there's a lot of potential value there to be had to make supply chains more resilient and basically finance an entire value chain more cheaply. Another trend we have seen more in the past couple of years is sustainable supplier finance. So I think that's a very natural product, supplier finance, to implement sustainability. Because if you give a corporate a sustainability-linked loan, you're just incentivizing that one corporate. Whereas in a supplier finance program, you may be dealing with your one client, but there might be 100 suppliers. So if you tell those 100 suppliers to act differently and they're going to get a better margin, they will actually be incentivized to do so. Another one is deferred pay structures. Spoken with a couple of market participants, also fintechs, last week at another conference, and they say, yeah, there's just a lot of demand for clients for deferred pay structures. What that basically means is it's the same as supplier finance, but the only thing is you keep the existing payment term between the supplier and the client. So let's say it's 30 days now. In a standard supplier finance deal, if you want the buyer to benefit, they need to renegotiate the payment term to 90 days or 60 days to get that working capital benefit. In deferred pay, you keep it at 30 days. And then you allow the client to pay back later through a payment service provider, a fintech such as Flav or others. And that will allow the client to say, okay, we're not due to make this repayment to a bank, but to a fintech or to a payment service provider, so we can maintain the other payable or trade payable classification. So that's definitely a valuable solution, and we see that being used more often. I think finally, accounting has driven a lot of change. So the fact that IFSB, FASB have driven more transparency on supplier finance programs. Initially, we were a little bit afraid of rating agencies zooming in on that, and companies not using the product anymore or using it less. We actually have seen that for some programs, but those were mostly the ones where either a very substantial portion of the balance sheet was relying on that one supplier finance program, or the payment terms were excessively long, let's say 360 days. So we have seen some of them bring back the payment terms or bring back their dependency on that program for the entire balance sheet. But on the flip side, the increased transparency has really brought a lot of new corporates to consider supplier finance. And we actually see the market overall growing more rapidly since that introduction. So with that, I'll hand it back to you.
Yeah, that's good. So I think that's a good transition for us to ask the question, with all these innovations, with all these market dynamics, how do fintechs and banks collaborate better? How do we improve and have meaningful collaboration? So maybe we'll start from kind of a general viewpoint of, as a bank, how does Rabo view kind of the collaboration landscape between fintechs and banks? Is it working the right way today? Is there room for improvement there? So let's start at a general sense. Like how do banks and fintechs collaborate or participate in the space together today? And let's see if we can give some practical examples afterwards and how our relationship has kind of played out.
Yeah. So as Rabobank, we're very deliberate in our strategy that we follow the client in whatever they want to do. So about 1/3 of our transactions are on our own platform. We do have our own platform. About 1/3 are with fintechs, such as PrimeRevenue and many others. And about 1/3 is with other banks, where the other bank leads the deal. So I had to learn as well. Initially, when I was sort of going to a client, I said, you need to go with Rabobank because we have the best platform. No, that doesn't work. If you really want the client's attention, you need to be able to tell them what the market landscape is and how fintechs in certain instances can just do things better than banks, and in certain instances, a bank may be better to provide a solution. So maybe I'll just give one or two concrete examples. Concrete example where we would advise the client to go with us is, for example, in the coffee space. Why? Because Rabobank knows all the buyers of coffee, and all the suppliers of coffee are clients of ours as well. And generally, there is a small program with, let's say, 10 suppliers. We onboard those 10 suppliers. That's very easy. Go with Rabobank. However, if it's a larger program and that client is really focused on also helping the medium-term suppliers, medium-sized suppliers, and the smaller suppliers, there's going to be a lot of implementation work. There's going to be a lot of data analytics. There's going to be a lot of onboarding, especially PrimeRevenue with the electronic time draft. Basically avoiding the need for UCC filings has been very helpful for us to roll out those types of programs.
That's great. So you mentioned a little bit briefly, why does the partnership with Rabo and PrimeRevenue work today? Maybe we can use it as a little bit of dissect it a little bit so we can share on both sides, maybe showcasing for other fintechs and for other banks to motivate better collaboration in the space.
Yeah, I think PrimeRevenue has been around for a long time. So I think we've been working together for 10 years. PrimeRevenue is our longest standing partnership. But as mentioned, we do work with a lot of other fintechs as well. So I think PrimeRevenue is strong, as I mentioned, in the electronic time drafts, the automatic supplier onboarding. What we really like as a bank is that you go into our banking systems and you pay the supplier basically with our bank account.
That's right, yeah.
We don't have to do anything. It's all fully automated. We find that very helpful. There's other fintechs out there like Taulia, which, because they're owned by SAP, they might go to a client and say, we already have all your data because you have SAP as your ERP system. So it might be very efficient to implement a supplier finance program with us. Other fintechs like C2FO, they might be better in dynamic discounting where they don't use the bank funding, but they go straight to payments of suppliers. So there's actually quite a scattered landscape, and really depending on the client demand, we can best serve them with one of those solutions out there in the market.
Yeah, I think that's a really good way to think about it. We always try to put the need of the customer and figure out what solution better serves that customer. So just like the way you guys are looking at it, PrimeRevenue is looking at it the same way. We might not be the best fit for every deal, but let's find the overlap between a financial institution and PrimeRevenue where we can bring the best value for that customer. So for example, in our partnership with Rabobank, we don't necessarily have all the strong customer relationships, right? They're a global bank, has terrific, capital deployment capabilities in a bunch of different currencies, in a bunch of different jurisdictions, but they have deep expertise and relationship with clients in, the food and ag space and the renewable energy space, in areas that PrimeRevenue as a technology provider won't necessarily have those embedded customer relationships that you all would have. So I think it makes a really terrific partnership when we can come alongside and say, you get to maintain the strong, deep tie relationship to your customer. We get to be able to support that through our, technology expertise and provide kind of the seamless onboarding and integration capabilities. And together, if it's a more meaningful relationship or a more meaningful drive for the customer, then let's figure out how to do that together. And so there's been numerous instances, even over the last, 12 or 6 months, where customers have said, we like the bank for all the reasons I already mentioned. We like the capabilities that you guys have. We would really love a solution where you guys would work together. So it's been driven by the client where they've had us respond jointly to RFIs, where they've had us support various portions of jurisdictional business together because they understand that individually, neither of us were exactly the right tailored fit solution. But you start to collaborate and bring some of that together, then you create a really dynamic, seamless solution to be able to service whatever jurisdiction and whatever creative structure needs to happen for that client to be supported. I think that was really important.
Yeah, and it works the other way around as well. So every now and then we get asked by clients, like, we have a program with a fintech, but it's not going as well as we expected. Can you guys step in and take it over? And we will tell them, well, the problems, the issues that the fintech is running into will very likely run into that same issue as well. It's also, we view fintechs as our partners, so that's one. But it's most importantly, we really think it's in the client's best interest to stay with the existing program, not move all the suppliers over and basically inconvenience those suppliers.
Great. So we're getting close here. We're getting warnings on time. So I do want to get to a little bit of interactive, being able to tackle some of the questions. But so maybe we'll jump ahead and just looking ahead. How do you see this bank fintech partnership landscape and the industry generally evolving over the next 3 to 5 years? What's your point of view?
I'll keep it short because we want to at least allow a couple questions. Generally, it's about taking away friction. So the more we can take away friction of suppliers being onboarded on programs, the more adoption there will be, and the better the working capital benefit will be for the client. So I think that's really the key. And with all the innovations that we're seeing and those new sort of type of variants of supplier finance that we mentioned, and all different types of sort of services that fintechs and banks can provide, we're basically expanding the toolkits for our clients. So I think those are the two combinations of what I see continue in the next couple of years.
Yeah, and I'll just highlight what I've said already. Real-time driven data analytics, financing decisions to be made even more instantly. Just being able to follow the customer and being able to provide a better solution. And I think with all the demands and the bar being raised, no one company or institution is going to be able to solve it alone. So the next phase of SCF is definitely going to be about collaboration, not competition. That's our viewpoint. So with that, I guess maybe it's a good time to open it up. I see some Slido questions up there. Maybe we can tackle some questions.
I like this first question because I was going to speak to it. So thanks for whoever put it on there. Do you see disclosure requirements and rating agencies shortening payment terms? So I think rating agents can only deal with the information that they are provided, right? And what the accounting standards have now said is, okay, you need to disclose if you have a program and you need to disclose the size of the program, but you don't have to disclose the number of days of your suppliers in a program versus the number of days of a supplier outside of the program. So effectively, the rating agents still don't have the details that they need to add back debt. I think that's really a key point. I don't know if that's a result of lobbying. It might be. We didn't like disclosure to begin with either, but now that the disclosure is there, there's more transparency and we see the adoption. So I think it might actually be a good thing if there is transparency on what are your payment terms for suppliers in the program and what are your payment terms for suppliers not in the program. Then it's very clear to what extent you are dependent on really stretching the payment terms in such a program. And then rating agents can also be much more specific. Now basically S&P says anything over 90 days will add back as debt, if we can even see it. But if you're looking at like meat or dairy, 30 days is really the max. There's even regulation for it. Whereas if you're looking for like a wind project, if you're buying wind turbines, 360 days should be okay, because this is a capex good. So the 90 days somewhere in the middle and everything over is bad and everything below is good. It just isn't realistic. So I think with further increase and collaboration between accounting standards and rating agents, we can get to a better landscape.
Awesome. Do you think supply chain finance providers and fintechs will have to increase reporting on their activities so that the U.S. can enforce tariffs? I don't see our activities as standing in the way of the U.S. enforcing tariffs if they need to. I think there will probably be, if tariffs continue in the direction that they're anticipated, we'll probably be expected to provide some clear transparency into what the activities actually are. But I don't think the data is coming out of the fintechs or the banks for the actual tariff enforcements. I think there's other ways that the government is getting to the data.
Really great. I think our time is up. I'm not sure if there's any last question from the audience. Otherwise, we'll go off stage.
They might have to kick us off afterwards. No, if not, we thank you for the time. And in the theme of better collaboration, whether it's bank to bank or fintech to bank, we're open to all sorts of discussions and sharing our notes and homework, ultimately to benefit the overall trade supply field. So happy to continue conversations even individually. So thank you all very much.
Thank you.